Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be analyzing Coca-Cola. We will look at Coca-Cola's operating segments, review its key ratios, perform a discounted free cash flow DCF analysis to find the intrinsic value of the company, and finally do an expected rate of return calculation to see if we were to invest in Coca-Cola at the current stock price, what kind of return can we expect on this investment? So let's dive in and look at Coca-Cola. Hey guys, let's start off by looking at the Form 10K to get a better idea of Coca-Cola's operating segments and its business. Over here, the company states that it is the world's largest non-alcoholic beverage company. Coca-Cola owns and licenses and markets more than 500 non-alcoholic beverage brands. The company also states that it owns and markets 4 of the world's top 5 non-alcoholic sparkling soft drink brands, which include Coca-Cola, Diet Coke, Fanta, and Sprite. The company also states that it is somehow involved in selling about 2 billion servings of the approximately 61 billion servings of all beverages consumed worldwide every day. Next, looking at the operating segments, over here Coca-Cola states that it has 6 operating segments along with its corporate segment. The first operating segment is the Europe, Middle East, and Africa segment. The second is the Latin America segment. Third is North America segment. Fourth is Asia Pacific. Fifth is Global Ventures. Sixth is Bottle Investments. And lastly, it also states that its corporate segment is also included as one of its operating segments. Now let's look at the change in the net operating revenue for Coca-Cola's operating segments. Over here, Coca-Cola states that its net operating revenues were about $34 billion in 2019 as compared to about $34 billion in 2018, which amounted to an increase of about 9%. When we look at the split up amongst each segment, we saw that Europe, Middle East, and Africa was the only operating segment that saw a decline. All the other operating segments saw an increase in its revenue. Now let's review Coca-Cola's operating income and operating margin within each segment. Over here we can see that Europe, Middle East, and Africa amount to about 35% of Coca-Cola's operating income. Latin America amounts to 23%. North America is about 25%. Asia Pacific is about 23%. So this split up shows us that Coca-Cola's revenue is not only diverse from a geographic standpoint, but most of its revenue is outside of North America. So if you are looking for a foreign exposure to foreign currencies, foreign markets, Coca-Cola might provide you that exposure. Next, looking at the operating margin within each segment, Coca-Cola states that the way they calculate the operating margin is by dividing operating income by the net operating revenues. So essentially, the way we calculate operating income is we subtract the cost of goods sold and the operating expenses from the revenue. We can see that on a consolidated basis, the operating margin is about 27.1%. What this means is every $100 that Coca-Cola makes in its sales, by the time it pays for its cost of goods and its operational expenses, it has about $27 left as profit. When we focus on the operating segments, we can see that Latin America is the most profitable segment as far as operating margin goes. About 57.7% of Latin America's revenue translates to operating profit. Now that we have a better understanding of Coca-Cola's core business and its business segments, let's review the company's key ratios. Hey guys, now let's look at the key ratios. I'm on Morningstar, looking at Coca-Cola. Under key ratios, financials, the first item on the list is the revenue. The revenue is the top line of the income statement. These numbers give us an idea of how much the company has made from its sales in a calendar year. All the numbers that we'll see here are going to be in millions of US dollars. We can see that back in 2010, the revenue was about $35 billion. The following year, in 2011, the revenue jumped up to about $46 billion. And then we can see that all the way up until 2015, the revenue hovered in the $45 billion range. And then we saw a decline in revenue all the way up until 2018 when the revenue was about $31 billion. And the following year in 2019, the revenue jumped up to about $37 billion. For the trailing 12 months, the revenue is about $33 billion. Next, looking at the operating income. The operating income is the amount of money that's left with the company once it's done paying for the cost of goods and operational expenses. We can see that the operating income follows a similar trend as the revenue, where back in 2010, the operating income was about $8.5 billion. It jumped up to about $10.1 billion in 2011, and it hovered in that range up until 2015. Then we saw the operating income decline up until 2018, and then in 2019, we see a jump again to about $10.5 billion. The operating income for the trailing 12 months is about $9.6 billion. After that, looking at the net income. The net income is the bottom line of the income statement. This number gives us an idea of how much money is left with the company once it has paid for the cost of goods, the operational expenses, interest on its debt obligations, taxes, and so forth. we can see that back in 2010, the net income was about $11.8 billion. In 2011, it was about $8.5 billion. And in 2019, it was about $8.9 billion. We can see that back in 2017, Coca-Cola saw a drop in its net income. This is primarily because of the new Tax Cuts and Jobs Act that got passed, and Coca-Cola had to pay a sizable amount in taxes during that year. Apart from that 1 year in 2017, we can see that for the past 10 years, the net income has stayed fairly consistent. Next, looking at the dividends, we can see that back in 2010, Coca-Cola paid about 88 cents as dividends, and for the year 2019, it paid about $1.6 per share as dividends. For the trailing 12 months, it was about $1.63 per share. We can see that over the past 10 years, Coca-Cola has been hiking its dividends. This is certainly a good trend. As shareholders, we want to see companies that are paying consistent dividends and also hiking their dividends. That way, we would be getting our money back that we invested in the company quicker in the form of dividends. After that, looking at the payout ratio compares the company's dividends to its income. We can see that back in 2010, 34.8% of Coca-Cola's income was being paid out as dividends. And for the year 2019, about 84.6% of its income was being paid out as dividends. For the trailing 12 months, it's about 84.5%. We can see that over the past 10 years, the payout ratios have been increasing. However, it's not to a point where things are getting out of control. And the reason why we're seeing an increase in the payout ratio is because if you look at the trend for the net income, we saw that it's fairly steady. However, we saw that the company is hiking its dividends. So more money is being paid out of the company in the form of dividends, but not enough is collected to increase that income. And that is solely the reason why we are seeing an increase in the payout ratio over a 10-year period. Next, looking at the shares outstanding, we can see that Coca-Cola's shares outstanding back in 2010 was at 4,667 million shares. After that, it looks like Coca-Cola did a lot of buybacks as the share count dropped all the way down to 4,299 million shares in 2018. After that, the shares outstanding number went up, which shows that Coca-Cola did some equity financing. For the trailing 12 months, Coca-Cola had 4,322 million shares outstanding. If we look at the 10-year period, we can see that the shares outstanding number has dropped. This goes to show that Coca-Cola has been buying back its shares for the most part, which is good for the existing shareholders since it increases their ownership within the company. Next, looking at the book value per share, the way Morningstar calculates its book value is it subtracts the total liabilities that the company has from the company's total assets. We can see that back in 2010, Coca-Cola's book value was about $6.76 per share, and for the trailing 12 months, it's about $4.33 per share. This goes to show that Coca-Cola either has been increasing its liabilities or decreasing its assets, which is the reason why the book value over the past 10 years has decreased. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. We can see that back in 2010, the free cash flow was about $7.3 billion. For the year 2019, it was about $8.4 billion. And for the trailing 12 months, it's about $7.3 billion. We can see that over the past 10 years, the free cash flow number has stayed fairly steady and positive, which is a good sign. I will be using the past 10 years of free cash flows for my expected rate of return calculation, and I will be using the 2019 figure of about $8.417 billion for my DCF discounted free cash flow analysis. Next, looking at the profitability of the company, the first item on the list that we'll talk about is the net margin. The net margin compares the company's bottom line to its top line. In other words, is the ratio of the net income to its revenue. We can see that back in 2010, the net margin was about 33.63%. For the year 2019, it was 23.94%. And for the trailing 12 months, it's about 24.90%. Next, looking at the return on equity. The return on equity compares the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in companies that have a return on equity of 8% or greater every year for the past 10 years. We can see that back in 2010, Coca-Cola's return on equity was about 42%. And over the next 10 years, for the most part, the return on equity has stayed greater than 8%. For the year 2019, the return on equity was about 49%. We can see that Coca-Cola's return on equity has been pretty high. This is because its capitalization structure is such that its debt, its liabilities are a lot more than its equity. So when we compare the net income to the small equity number, we would be getting these inflated return on equity numbers. After that, looking at the return on invested capital, the return on invested capital gives us an idea of how good the management is at allocating the company's capital and getting a return on that investment. We can see that back in 2010, the return on invested capital was about 26.69%. And for the year 2019, it was about 15.11%. Finally, looking at the interest coverage, this number gives an idea of how many times can the company pay off its interest obligations using its income. We can see that back in 2010, the company could pay off its interest obligations 20.43 times. And for the year 2019, it could pay off its interest obligations 12.40 times using its 2019 income. Benjamin Graham, the father of value investing, preferred to only invest in securities that provided an interest coverage of 5 times or greater. Next, looking at the financial health of the company, focusing on the liquidity measures, the first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to see the current ratio to be greater than 1.0. We can see that back in 2010, the current ratio was about 1.17. For the year 2019, it was about 0.76, and for the latest quarter, it's at 1.13. We can see that apart from year 2019, every year for the past 10 years has had a current ratio greater than 1.0. Next, looking at the quick ratio. The quick ratio is similar to the current ratio, except it disregards the inventory. In other words, quick ratio is equal to current assets minus inventory divided by the current liabilities. Ideally, we want to see the quick ratio to be greater than 1, as that would indicate that the company does not have to depend on selling its inventory in order to pay off its current obligations. We can see that back in 2010, the quick ratio was about 0.85, and for the year 2019, it's about 0.56. For the latest quarter, it's at 0.93. Next, looking at the financial leverage, we can see that back in 2010, the financial leverage was at 2.35. In 2019, it was at 4.55, and for the latest quarter, it's at 5.22. We can see that over the past 10 years, the financial leverage has been increasing. Next, looking at the debt to equity ratio, this number compares the company's debt to its shareholders' equity. We can see that back in 2010, the debt to equity ratio was at 0.45. For the year 2019, it's at 1.45, and for the latest quarter, it's at 2.12. We can see that both the financial leverage and the debt to equity ratio indicate that the company for the past 10 years has been taking on more debt. Especially in the last 12 months, we can see that both the financial leverage and the debt to equity ratio have jumped up. When we compare the financial leverage and the debt to equity ratio to its competitors such as Pepsi, we can see that such a trend is comparable. In fact, Coca-Cola has a better financial leverage and debt to equity ratio than its competitors. Next, looking at the efficiency ratios. The first item on the list is the day sales outstanding. This number gives an idea of how many days go by from the day Coca-Cola recognizes its sales to the day it actually receives cash for the service rendered. We can see that back in 2010, it took Coca-Cola about 42.55 days to receive cash, and for the year 2019, it was about 36.08 days. For the trailing 12 months, it is 44.60 days. We can see that over the past 10 years, the day sales outstanding number has stayed steady, which is something that we want to see, as an increasing day sales outstanding number would indicate that the company is taking aggressive measures as far as accounting goes in order to recognize the sales early to bump up its income. Next, looking at the days inventory, this number gives an idea of how many days does a company's product sit in the inventory before it's sold. We can see that back in 2010, Coca-Cola's days inventory number was at about 72 days, and for the year 2019, it was about 76.71 days. For the trailing 12 months, it's about 88.80 days. We can see that the days inventory number for the trailing 12 months is a lot higher than we see in 2019. This is because Coca-Cola's sales volumes dropped off, which caused the company to build up on its inventory, leading to a higher days inventory number. Next, looking at the payables period, this number gives an idea of how many days does the company take to pay its suppliers. We can see that back in 2010, Coca-Cola paid its suppliers in about 47 days, and for the year 2019, the company paid its suppliers in about 78.67 days. We can see that there has been an increase in the payable period over the past 10 years. This goes to show that the company is holding on to its cash for a longer time, which in a way is a good thing because it can employ its cash at better places than just paying off its suppliers as soon as possible. Finally, looking at the inventory turnover number, this number gives us an idea of how many times does Coca-Cola's inventory go through its system in a calendar year. We can see that back in 2010, the inventory turnover was at 5.07 times, and for the year 2019, it's about 4.76 times. We can see that over the past 10 years, the inventory turnover has fluctuated between 4 to 6 times. Finally, let's look at the company's current valuations. Over here, we will be comparing Coca-Cola to the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. We can see that Coca-Cola's current PE ratio is at 28.4, whereas S&P 500 is at 27.2. Next is the price to book ratio. Coca-Cola is at 12.7, whereas S&P 500 is at 3.8. Next is price to sales. Coca-Cola is at 7.1, whereas S&P 500 is at 2.7. After that, price to cash flow. Coca-Cola is at 26.6, whereas S&P 500 is at 15.8. And finally, the dividend yield. Coca-Cola's dividend yield is 3%, whereas S&P 500 is at 1.7%. So on all these valuation metrics, other than the dividend yield, we can see that Coca-Cola is overvalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for Coca-Cola. Over here, I pasted the 2019 free cash flow number that I got from Morningstar, which was $8,417 million. I'm using the annual growth rate of free cash flow to be 5%. What this means is I'm expecting Coca-Cola's free cash flow to grow at 5% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I'm expecting this investment to give me a return of 10%. I'm using a long-term growth rate of 3%. What this means is I'm expecting Coca-Cola's free cash flow to grow at 3% every year from the 10-year mark into perpetuity. Coca-Cola has 4,322 million shares outstanding and has a long-term debt of $27,516 million. I got this number from Coca-Cola's balance sheet. After taking all of these inputs into account, we get the intrinsic value to be about $26.02 per share. If we compare this intrinsic value to the current stock price of about $54.84 per share, we can see that we would be paying a premium of about 2.10 times. The way we derive this intrinsic value is we look at what the free cash flows will be every year for the next 10 years. We sum up all those free cash flows. Then we look at what the free cash flows will be from the 10-year mark into perpetuity. We sum up all those free cash flows and get the intrinsic value to be about $139 billion. Then we subtract the long-term debt from this number and divide by the shares outstanding to get the intrinsic value per share to be about $26. Now, if we disregard the perpetuity component, in other words, if we just think that Coca-Cola is going to grow for the next 10 years and then stop growing, then we get the intrinsic value without the perpetuity component to be about $9 per share. Hey guys, now let's look at the expected rate of return calculation for Coca-Cola. Over here, I pasted the past 10 years of free cash flows that I got from Morningstar. This is the yearly free cash flow trend that we get. We can see that over the past 10 years, the free cash flow has stayed fairly stable and positive. Next, looking at the future data and predictions, I'm assuming that there's a 15% likelihood that Coca-Cola's free cash flow will grow at 3%. There's a 50% likelihood that its free cash flow will grow at 2%. And there's a 35% likelihood that its free cash flow will decline at 3%. These are the potential free cash flow rates that we get into the future. After taking into account the numbers of shares outstanding, which is 4,322 million shares, at the current stock price of $54.84 per share, we can expect to get a return of about 1.1%. What this means is if we were to invest in Coca-Cola at the current stock price of $54.84 per share, we can expect to get a return of about 1.1% on this investment. Hey guys, now let's wrap it all up. We saw that Coca-Cola's revenue, operating income as well as net income for the past 10 years has been positive and fairly consistent. The dividends have been growing, and although the payout ratio has been increasing for the past 10 years, the dividend payouts appear to be sustainable in the future. We saw that Coca-Cola's return on equity was greater than 8% every year for the past 10 years, except in 2017 when it had to pay higher taxes caused by the Tax Cuts and Jobs Act. Additionally, Coca-Cola's interest coverage is greater than 5 times, which indicates that the company is easily able to pay off its interest obligations on its debt using its income. After that, we looked at the company's current and quick ratio, which showed that the company is fairly liquid, although it is dependent on selling its inventory in order to pay off its current obligations. We also looked at the company's financial leverage and debt to equity ratio, which is fairly comparable to its competitors. When we looked at the efficiency ratios, we saw that the company's efficiency has stayed fairly consistent over the past 10 years, although for the trailing 12 months its inventory has gone up, primarily because of the government shutdown, which caused its sales to drop off and its inventory to build up. From a valuation standpoint, we saw that other than the dividend yield, all the other valuation metrics point out that Coca-Cola is overvalued to the S&P 500. Next, when we did the discounted free cash flow DCF analysis, we saw that the intrinsic value of Coca-Cola comes out to about $26 per share, which when we compare it to the current stock price of about $54.84 per share would mean that the current stock is trading at about 2 times its intrinsic value. Next, when we did the expected rate of return calculation, we found out that if we were to invest in Coca-Cola at the current stock price of about $54.84 per share, we can expect to get a return of about 1.1% on this investment. In conclusion, we can see that fundamentally Coca-Cola is a great company. It has a high profit margin, which indicates that the company has a moat and pricing power. Over the past few months and years, Coca-Cola has been divesting from its bottling business, which is more capital intensive. And by focusing just on the syrups and concentrate business, Coca-Cola will be increasing its profit margin even more. Furthermore, we saw that Coca-Cola provides us a great exposure to international markets and foreign currencies. So if you are concerned about how the US dollar or US economy may turn out, this company, Coca-Cola, provides us a great exposure not only to different countries, but different economies and geographic areas. Hey guys, that is all I have for you this week. Hopefully you found this video on Coca-Cola interesting. Please do like, share, comment, and subscribe to my channel. And if you have any suggestions as to which stock I should review next, please leave it in the comment section below. I will greatly appreciate it. Thank you.